Hello there, this is Chris at Verillo Trading. In today's video, we're going to talk about something that is pretty interesting that we find interesting, and that is how to practice day trading, or how to do something called a trading drill. In this video, we're going to talk about practicing, the importance of practicing, and then we're going to do a section on how to practice your unique way of trading and interacting with the markets. And then maybe towards the end of the video, we will give an example of how we practice our own trading drills a few times per week so that we can keep our skills as sharp as they need to be, so that our executions are as good as they can be on any given day without any hesitation. So guys, if you enjoyed this content, remember to press the like button, subscribe to the channel, check out other videos on the channel, all of that. And if you want to learn more about the brokers that we use for day trading and for investing, you just check out the links in the description. Okay, so we'll start off by taking a sip of water, and we promise that it is water and not vodka. So, okay, let's start off by talking about the importance of practicing and the relevance of practicing. So, this is interesting because it's going to really depend on what you do and your unique way of operating. Everybody has their own way of operating, therefore your way of practicing is going to be different than anybody else's. You can learn different ways to practice, different ways to think about operating a certain methodology, but these methods, they can often fall short in how much they can benefit your own unique routine because they might be different than what you're actually trying to do. And we're going to talk about this more when we get to the second part of the video, which we'll talk about how to practice or how to implement a practice routine. The first thing we want to talk about is the importance of practicing. Many of you might not need to be convinced as to why practicing is important, but believe it or not, when you're constructing a methodology, even if it's a longer term idea about the market, you are still spending some time fine-tuning that methodology and kind of answering questions that are associated with that methodology. So even if it is some sort of a longer-term approach, the time you're spending that is dedicated to improving that methodology or understanding things further about that methodology, that is technically practicing. So there is a big difference between a natural talent or a natural sort of intuition and actual skill development that is done when you are practicing and developing your skills. In regards to trading, you can look at it in different ways. So, of course, some of you traders out there who do short-term day trading and scalping, you've heard of certain things like tick drills, where the trader might look to enter and exit in a very short amount of time, trying to basically work on the muscle memory of them clicking the mouse. And that specific way of practicing is based on a methodology that they have developed in their own trading. And that is what I really want to stress in this video, that you need to be practicing things that are relevant to the methodology that you are employing. Okay, and we'll talk about that more when we get to the second section. The reason why we think practicing trading is important is because in day trading, especially, you only do it for a couple hours a day at most. In fact, some people will argue that they can only really focus at the best of their ability for around 60 to 90 minutes. And then after that, they just can't perform anymore, or they're not as focused as they are in that 60 to 90 minute window. You understand what I'm saying? So say, for example, you trade for about an hour and a half a day at most, maybe 2 hours. And then for the rest of the day, you're doing other tasks that are completely unrelated to what you were doing when you were trading. So the muscle memory factor associated with your trading, you're only exercising it in those 2 hours. I think it's not enough. You often hear stories about these great artists and musicians who practiced for hours and hours a day when they were younger, and that is how they got that technical proficiency. In trading, it's no different. You can practice for hours a day, but the only issue is the market is not in optimal conditions to be practicing certain things. That is why when it comes to practicing trading, you have to be able to give yourself an accurate representation of the environments that are going to be present when you're executing certain decisions to trade. And I'll explain how we do that later in the video, so stick around. If you made it this far, guys, press the like button. It really helps and all that. So we definitely need to make it a point to keep our skills sharpened. Now we're going to move on and talk about how we do that. How to practice trading, or how to practice anything for that matter. The first thing is about the methodology. Having a great understanding, a very deep understanding of exactly what it is you're doing and where it's meant to operate. You need to know your method of trading and the method of trading that you employ based on X, Y, and Z criteria that is present in the marketplace. So there are many components that go into how a market operates. There's many components that can go into a certain trading strategy or methodology that you develop. It does not matter if the strategy is being executed by a human or if you're telling a machine to do it for you. You still have to give the variables to the machine to do it. Therefore, when you're developing the machine to trade for you, you are testing, and that is you're practicing, kind of, right? It's just that when it comes to that point, the machine is doing the clicking of the mouse for you, but the method that you're employing is still the same thing. So the first thing is having a very good understanding of the methodology that you employ or the thing that you want to be practicing. And I'm going to try to give you some examples. Let us say we have a certain strategy of trading, which could be considered in the realm of scalping or short-term trading. And in this particular strategy, we look to capture the average rotation of the marketplace. So let's say, for example, in this particular market that is in the middle of my screen, this is the 5-year Treasury note futures, and on the right of that we have the 10-year Treasury note futures. We are looking to capture a measured move around what is considered to be the average volatility of the marketplace. So when we employ a practice routine, we want to create exercises or create drills that are relevant to the way we will actually be trading that market when it comes to trading it in real time. You, as the trader, you know that when the market is moving X amount, when there's X amount of liquidity and there's X amount of volume going through the market, X, Y, and Z factors that are lining up, you trade the market in this specific way. That is the kind of environment that you need to be able to replicate in your practice environment. And you need to create practice drills that are relevant to the way that you are trading that market based on how you determine you're going to trade it. Okay? So on this given day, in this given moment, I have determined that the most ideal way that I'm going to look to trade this market is look to trade in 3 to 5 tick rotations. So now that I understand exactly how I'm going to be trading it, when it comes time to my practice routine, I will be practicing trading those 3 to 5 tick rotations. I can focus exactly on executing what it is that I need to do. The clearer understanding you have of what it is that you need to practice and the application of what it is you are practicing, then the easier it is going to be for you to implement that practice routine. And the benefits of doing this is going to be that there will not be any sort of loopholes in your overall process when it comes time to executing the trade in real time. Because in your practice session, you're fixated on improving and removing those loopholes that are potentially in your trading process, certain things that you might not really be ready for. You understand your method of trading, but you have not necessarily put in enough time into the physical execution, the manual execution of your strategy, that you may be missing a few extra loopholes, or maybe there is something that the market needs to teach you about your methodology that you have not yet learned. And that is why we use things like market replays to help us replicate these live environments as accurately as possible. Now, if you guys watch my video on demo trading, you guys understand that there are ups and downs to demo trading, and that, of course, at the end of the day, the demo trading environment or the practice space environment will never, and I mean ever, be exactly like the live environment. And you, as the experienced professional who know exactly the environment that you're engaging in and exactly the method that you're employing in that environment, you are supposed to know the limitations of the demo environment and the limitations of that market replay environment that we're going to continue to talk about here in this video. So what I'm trying to explain to you guys is that in order to really have productive practice sessions, you need to clearly outline exactly what it is you are practicing in that session. And it doesn't have to be like a whole 20-page plan. It's exactly the way you're trading in real time, except that you're just practicing the way you're trading in real time. So let's say, for example, you're a discretionary trader, and using the previous example I gave, you have a way of determining how you're going to trade that market or what strategy you're going to use to trade that market based on what you are currently seeing in the market. An algorithmic trader, they may have developed or coded a certain indicator that already does the math for those things and tells the system exactly what's the average volatility, what's the liquidity or the average liquidity, and if they use client-side triggered orders based on liquidity, what is the amount of liquidity that needs to be present or not present for those orders to be triggered. All of these things can be quantified. So it does not really matter if you're an algorithmic trader or a manual trader. I'm just kind of explaining to you the concepts that I think are relevant when it comes to practicing a method or improving on a method. So the next really important thing here is that you want to find a way to replicate the live environment as much as you possibly can. Ideally with a simulated environment like a market replay, or you can also implement mental exercises for practicing. I'm sure you've heard of mental practice before, where you can do visualization exercises for the mechanical movements that you make when you're executing your process. Now, of course, if you don't have that physical experience, that hands-on experience, you're going to have a bit of a hard time doing mental visualization exercises. So I do recommend the first method first, which is using a market replay or reviewing your screen recordings. That's another way to do it. In the software Sierra Chart, this is the software that we use for trading, there is a feature called the market replay. But basically with the market replay, you can replay the market tick for tick exactly the way it played out. And that includes with the market depth or the level 2 data that was present in those given moments. And that is really a great advantage of this particular software. There are certain limitations, and I will kind of try to explain them to you a little bit. For example, let's say you're a short-term trader and you operate using, limit orders to buy and sell. And maybe you use other more advanced order types that operate on the client side of your software. These are orders that are meant to be triggered based on certain things that happen with the market depth. There are scenarios with the market replays that not everything can be 100% totally accurate. And the reasons for that I'm going to leave out of this video because it's just kind of really complicated understanding about how these things are actually developed, and we don't really need to talk about it in the video about practicing. But basically what you got to understand is that no matter how close you get to that live environment, it's never really going to be the exact same thing. And there is reasons for that that are related to your psychology. Of course, your psychology is different when you're in the practice space versus in the live environment. And of course, there are limitations to how accurate a market replay can actually be in terms of if you're using certain very precise ways of executing, like client-side orders that are meant to trigger based on market liquidity, and other things that are kind of complicated to explain in a video. So basically, you want to make sure that your practice environment is as close to your real environment as possible. I'll give you an example. So I do market replays using Sierra Chart. Now, issues that I run into is that in Sierra Chart, I use 2 instances of the software. One instance is for my trading and my trading execution. The other instance is for charts and more complicated study calculations and things that sort of should be out of the instance of the software that I'm using for trading, because I want to make sure that the performance in the instance I am using to trading is as good as it can be, and I don't want there to be any study calculations that are taking place that have the potential to bog down the sending and receiving of orders that I'm sending, okay? And this applies to me more because I do sort of precise trading. And of course, the faster and more responsive your trading execution is, the better that's going to be for you. Okay, and I explained that in a different video I made about Sierra Chart performance optimization. You can check that out as well. So in short, I use 2 instances of the software, meaning that when I do a market replay, I actually need to replay 2 instances of the software at once. And the way I do that is by simply clicking the play button at the same time for both of them. So just for the sake of this video, we'll move this over to the other screen. And of course, there is going to be a few steps associated with doing the market replay that potentially I'll leave it for another video. I'll create another video called How to Do an Accurate Market Replay in Sierra Chart in 2 or more instances at once. Just kidding, the title's not going to be that long. But the first thing that I do is I have to download the market depth data, because the market depth, or the level 2 data as some of you know it, is very important data for my own particular way of trading. So my method of trading requires me to have exactly accurate market depth data so that way I can replicate that live environment. Luckily, the software provides me with all of that, so it provides me with an accurate practice environment. So the first thing, like I said, is download that market depth data for the days that I will be replaying on all of the markets on my screen. So for me in particular, since I look at US treasuries, I will be downloading the market depth data for the 2-year treasury, 5-year treasury, 10-year treasury, and 30-year bond. And once I've done that, I need to go ahead and configure the replay. And in this case, I've just set it to be March 31st, and I'll replay it at a time of 8:20 a.m., which is the open of the bond market pit session. And then what I'll do is I'll go ahead and press play. Let me just drag that over. And basically what we'll do here is we'll make sure not to clear our trade data for symbol and account, but I'll talk about this in another video I'll make. And then we simply hit OK on both of them at the same time because we're playing back the market in 2 instances at once. And now here we have started a market replay. Now, this is the environment that I use to run my trading drills for US treasuries. Now, I'll give you an example of a trading drill that I use to practice trading US treasuries, scalping trading that is. Okay. So on this screen, we have the 5-year treasury in the middle, the 10-year treasury right here off to the right, the 30-year off to the right, and then the 2-year off to the left. I didn't download the market depth for the 2-year. As you can see, it is missing there, but that is no big deal. So here's an example of a trading drill that I will give to you guys. Now, like I finished telling you guys, I believe that it is absolutely crucial that all of the variables that you use in your trading, you need to have them in front of you when you're in your practice space. And that is why a screen recording, it can fall short. Normally with a screen recording, you can only record 1 or 2 screens at once. And when you record the screen, you're not really going to be able to play back the recording of 2 screens at once on 1 screen, because that's not going to give you the same visual representation that you have when you're actually in that live environment. Like we said, we need to keep it as close as possible to the live environment. So with this market replay, that is for me the closest way that we can get there. So we have an exact replay of what the market is doing on X given day at X given time, except that it's not real money, but the market is operating in real time. We're replaying a real-time market. So I just wanted to kind of clear up those concepts because I think it is very important that you understand this, because I've spent so much time reviewing screen recordings in the past, and I believe it's a good thing to review your screen recordings, but if on another screen you're using charts and there is some information that is important on those charts relating to the market context, and you have not recorded that in your screen recording, you're missing out on important variables that you would have been using otherwise in your trading. So if you're reviewing your market recording without certain information that you are using to trading, then when it comes time to doing that review, you're missing very vital data. Okay, that's the point I'm trying to get across here. I'll now proceed to show you a trading drill that I've sort of created or built around a way that I actually use to trade the markets and a way that I use to keep my order executions as fine-tuned as possible. I will generally look to enter a trade with very minimal movement offside. There should not actually be any movement offside of my trade upon the entry of that trade, because I'm looking for very precise entries, and oftentimes I want to make sure that I have the opportunity to potentially take a break even and retry the trade before the trade actually goes against me totally and I end up with a loss that could have been a break even. So it's called scratching. So this particular drill is going to be a drill that is centered around a win or a scratch type of trade. This particular trading drill is called scalping around the iceberg. So for US treasuries here, we have the 10-year treasury futures, 10-year note, and in the middle here we have the 5-year note futures. These are basically the only two that, we're going to look at here. So scalping around the iceberg, basically what we're doing is we look to either buy below the iceberg or sell above the iceberg. That is in the scenario that we are looking to buy low and sell high. Now, there are some scenarios based on your other market context and all that where you might want to buy high or sell low. In those cases, you would buy 1 tick above the iceberg and you would sell 1 tick below the iceberg. So it's up to you as a trader to determine the reasons why you would do that. Okay, so for whatever reason, let's say that I chose that I wanted to buy below this iceberg right here at 31. Now I've identified that this is an iceberg because I can see here we've traded 2,800, and actually we've traded a lot more than that because on the cumulative figure here we've traded around, hold on, we've traded around 5,371 contracts now at this point, and it's still trading some more. So here's an iceberg around 5,000 contracts. This is where we're currently trading. So the drill here is we're going to buy below the iceberg. So I got my limit buy order one tick below the iceberg, and I will look to exit one tick above the iceberg. So I'm scalping around the iceberg. That's the whole fundamental part of the entire drill. Now, I'm going to pull the order out temporarily because I think that, again, I'm basing this based on, the way I would actually look to trade this. And I think that it is possible to get a more fine-tuned signal in some cases. And of course, I've already seen the way this market played out, so I know, what's going to happen here. But here's an example of where the market moves, outside of this range, one tick below the iceberg, traded 4 contracts there. Now it goes offered here 800 contracts. And now what I'll look to do is if I see, either some of these offers are going to pull away, or if I see a buyer hit into that, and keep willing to hit into that offer at 30 and a half, and some contracts pull away, and maybe there's another signal coming from the correlation indicating to me that value is not really moving lower. In fact, we're probably going to go back and retest these 31s and 31 and a halves again. In that case, right there, you saw that. They traded 300 in the offer, the rest of them lifted up. And you can see here, we're actually witnessing a replayed trade that I had taken in my previous recording of this. So you can see here that I have bought the market at 30 and a half. And I am buying one tick below the iceberg. Now in this scenario, you can see that the market is still offered here at 30 and a half. So it's not actually a great entry. Ideally, what I would want to see is the market to stay bid here at this scenario and start trading 31s right away. So you can see here they go and trade another 5 down there. And really, I don't want to start seeing them print. So there we go. They print 200 on the offer. No more show up, maybe 100 more show up, and then they take it and it goes bid. So now we're in a good trade here. We've seen a buyer, step up, willing to take the bid here, one tick below the iceberg. Now they're trading 31s, and ideally, I want to be filled at 31 and a half. So in this scenario, my limit order to sell is already at 31 and a half. Now, because we're witnessing a replayed trade, you're not seeing the order there, but it is actually there, the order at 31 and a half. But it would look something like that right there, where you would have a limit sell order right at 31 and a half. Okay. And in some scenarios, I would have chosen to put the profit taker in even before I was filled on the parent order. Okay, so you guys see what I'm saying? It's about sort of, and the reason for that is because this market is relatively thick. There's thousands of contracts on each side. There are some scenarios where with this particular trading drill, I will put the profit taker in before I'm filled on the limit order to enter the trade. So again, the trading drill, scalping around the iceberg, wherever you see an iceberg, wherever you see the traders are trading, and then put your other context in there as well. If you're looking to buy low, you buy one tick below the iceberg and you're going to sell one tick above the iceberg. If you're going to buy a breakout, you're going to buy a breakout one tick above the iceberg and then look to trade around that. Now, there are certain nuances that will tell you that you need to be scratching your trade, sort of how I was going with it on the first example I showed you. Like, for example, if you are expecting the market to stay bid in your favor and not, start trading below your entry price. Like, for example, I was long at 30 and a half and I saw that there wasn't enough sellers that were willing to actively hit into that 30. That was one thing. And then they ended up taking the bid at 30 and a half and going bid. That was a factor that was in favor of my trade. Now, in this scenario that we would have seen more traders hit into that 30, it would have probably resulted in either looking to get that break even, meaning that you put your limit order to sell, join the offer and take a break even at your price, or in some cases, you might be forced to take a one tick loss on that. And of course, the worst case scenario is that it goes all the way and stops you out for whatever your stop is. But ideally for this particular drill, you want to develop the muscle memory of being quick enough to respond to what the market is informing you about your trade. The point of the market replay is to really keep your muscle memory skills sharp for the particular trading drills that you are doing. Like I said, when it comes to building trading drills, you want to be building them in a way that can help your execution when it comes to the actual trades that you're taking. That's why, in conclusion, develop a practice routine or a trading drill routine that you do a few times per week, maybe, and the drills that you're doing are directly related to the way that you trade in particular. All right, guys, if you enjoyed this video about trading drills and about practicing, let us know down below and let's have some awesome discussions. And we'll talk down below and we'll see you in the next video. Take care. Bye.